Welcome to this panel. I think this is probably very well aligned with the prior panel. As you look at tokenization of financial assets, what people now broadly call as real-world assets, has become a very big theme. Though it's been in for quite some time, the numbers which kind of reflect the amount of activity is not substantial, and that's been various reasons. Approval from a regulatory perspective gets quoted, at the same time broader infrastructure dimensions come into play. So in this panel, we'll try to discover kind of what are the risks, how people should look at it when you look at financial assets, but also delve a little deeper into what kind of activity we are still seeing. So, but I want to start off by getting our panel to introduce themselves. Maybe we can start with James, you, and then kind of go forward from there.
Okay, great. Thank you very much. It's a pleasure to be here. My name is James Wallis. I work with Ripple. Ripple is a financial services blockchain company. We have businesses in stablecoins, digital assets custody, and payments. My particular role is I'm leading all the work we're doing with global financial institutions and major asset managers. So looking forward to the chat.
Hi, Jasmine, Burgess, Chief Risk Officer of Coinbase Asset Management. So Coinbase, as you know, a big company, many different areas. We are the walled-off asset management arm. So we do everything from bringing anything that are trading enterprises and innovative opportunities for investment in the digital space, but also bringing to market tokenized product and buying tokenized product.
Hey everyone, I'm Dave Schwed. I'm one of the CISOs over at Robinhood, also ex-BNY and ex-Galaxy Digital.
Hey folks, I'm Tuff, CTO at BH Digital. We're kind of one of the largest digital asset managers focused on liquid and liquid strategies.
Well, thank you. I did some research before the panel to just kind of see what is real amount of activity in the financial asset tokenization space. And there are some great stats out there. If you look at it, about $20 billion, which currently exists in this space, a large part is private credit, which is essentially HELOCs, but then you see US Treasuries, money market funds as the next category. There are commodities, gold, etc., as well as another category. Institutional funds as another category. There is also a wide spectrum of issuers and a wide spectrum of investors. But the overall amount compared to global financial assets are like 400 trillion. The market cap of crypto is about 4 trillion. Here we're talking about like 20 billion on the public blockchains, and then there's another 20 billion, which are these bond issuances, which various supranationals have done. World Bank, EIB, Asia Infrastructure Development Bank, DFW. So across the board, there are a number of issuances which have happened. Mostly that's all happened on permission blockchain, so you don't really see that number, but that's almost another $20 billion. With a large number of investors and pretty cool structuring across the board, where people are seeing value in the process flow. So really the challenge is now how this all come together. What do we see there? So why don't I start with the first question for James? Trying to just understand better from your perspective, what are the key driving institutions, what are the key factors which are driving the institutional adoption of tokenized assets, and what is the right infrastructure which is needed to unlock it? Because definitely it's currently very fragmented.
Yeah, thank you. It's still very, very early stages. I mean, we've seen, I think, over the past several years, lots of institutions doing experiments and pilots and sort of testing the water. I think the big shift really started in 2024, last year. Ultimately, people want to make more money, right? Either by growing their customer base or having new products or assets, or they want to improve their margins, right? They want to lower costs or whatever. So those are the sort of very basic drivers. Ultimately, as you rightly said, depending on which consulting firm you believe, there's a range of real-world assets that will get tokenized. It's like from 2 trillion to 20 trillion by 2030. I mean, I have no idea which is accurate. If it's a trillion, that's a big number, right? I think the other factor is there's always this, the business drivers. We want to make more money. That has to be done within the regulatory environment, the different rules of the road in different markets. Obviously, we're seeing some positive signs starting to emerge with the new administration here. We probably won't get into all that. But also the technology is an enabler. So with tokenizing assets on a blockchain, there are several characteristics that you can take advantage of. Instant or near instant settlement. 24/7 transaction business. Lots of different reasons behind it. The access. I think one of the drivers to the public shift towards public blockchains is around liquidity. Right, this big access to liquidity pools. I do think that we will see this trend more towards public ledgers than private. There will always be a place, I think, in the market for both. I think like some of the comments on the previous panel, getting access to this capital around the world that started off in the sort of crypto space, so that's becoming, I think, more mainstream. That's, I think, the ultimate driver or enabler, if you like. So it's some combination of those three. I don't know what the actual number's going to be, but as a company, Ripple, we are heavily invested in this space and believe that a well-managed and well-regulated infrastructure will open up these opportunities around tokenization, not just replicating the current world, but also different use cases, and different business models.
Thank you. Just kind of moving on, Jasmine. You kind of manage risk at multiple financial institutions. And when you look at tokenization, there are positives of it. There are kind of things which you need to be careful about. What parts of kind of risk spectrum you think applies? Are there any new risks which participants should think about? And how do you look at this space overall?
I love this question because it's everything that I build my strengths towards. What are the risks in tokenization? And I hate answering it publicly because I do want to see tokenization thrive. But if we know the risks, then we can mitigate them well. And so one of the preeminent things that we've discovered in buying tokenized products, where we're facing some of the bigger named tokenization engines, there is zero uniformity in how people are approaching this. Either because they're based in Switzerland, US, Europe, various different areas that they're domiciled, but also their approach to technology, their approach to who they're partnering with, and what they're focused on. So there is no uniformity in tokenization in itself. We, as asset managers, are focused on tokenized funds. Now, that is a very different paradigm to tokenizing, say, a commodity or a carbon credit, because they're bearer instruments. So if you need to self-custody that or have it in a custodian, if that gets hacked, good luck to you. But if you have your fund token hacked, then you've got an administrator who shadows all the books and records and ensures that you still have something that you can have mint or burned to you. The lifecycle events can be rebuilt in to the administrator's smart contracts as well, because they can remint and reburn any of the tokens. So in starting with tokenized funds, you're really reducing the risk spectrum or the areas that could go wrong, because things can just get redistributed. Cyber is less of a risk, all of those attributes. But what we are seeing in the tokenized fund space is the disparity of vendors don't seem to understand fund management well. It's key to have separation between administrators, custody channels, and your investment bank. All of these things, we don't have enough vendors to give that full vertical spec. And so it's still just not at the institutional quality. There is a lot of promise. And when the promise comes, we hopefully will only see the main risks that we should be focusing on, which is not third-party vendor risk management, more what are the liquidity attributes? How do I make sure that something that is trad, working 5 days a week, gets mapped over to a peer-to-peer mechanism for 365 days? Can that even be possible? There's a lot of regulatory areas that won't allow peer-to-peer without the middleman involved to shadow the books and records of those cap tables or other holdings. And that's essential for understanding ultimate beneficial owners of all the various companies, as well as just understanding what exchange looks like when you're in an area of such heavy regulation. Other things like life cycles, like I've been 20 years on a trading floor, something goes wrong with the life cycle, you're like, jam it into Excel, the valuation will end up later. It's a lot harder to jam some clusters into a smart contract when it's already live and distributed. So it's going to start with very simple product. We're not going to get to your curve steepening, twos, tens derivatives. We're going to start with tokenized money market funds and things that are very well understood, because it is such a headache to get around the technology, the different governance of different chains. Is EVM even scalable? Do we need it on layer 2s? What is roll-up mechanism going to do if you're already optimistically settling everything and then 6 days later you're like, I don't know if we should have settled that one. That doesn't happen in finance. And then everything on Ethereum, like congestion is such a risk. We can have crypto kitties take out the whole platform for 3 hours. Does that mean no one's doing finance for 3 hours? It is a lot to digest, even for people in this space. So we are going to need to see progress being, smooth and slow for the right reasons, very similar to what Basia was saying. And the regulators, we are working very heavily with them on all attributes, including, the kind of new administration. Obviously, it's no secret. There's, crypto clubs that are being formed, working groups, to ensure that everyone is well aligned for the practicality of just building this in the right way.
Kind of makes a lot of sense. The demands which we'll have for a financial infrastructure is definitely much more heightened level and low level of risk requirements, much heightened level of diligence requirements, throughput requirements. So there's a lot to build there. Another component of this is around security. Currently, we live in a world where everything is behind a firewall, and institutions, DTCC to others, all kind of are behind a firewall. Now, Dave, Boney, Halburn, Robinhood, kind of from a security perspective, anything unique which people should think about and as they look at this space and tokenization of financial assets?
Yeah, I mean, I wouldn't necessarily say unique, but there's two threads that I would want to mention and pull on. When you're talking about whether it's digitally native assets or you're talking about a digital twin, you're still talking about the underlying asset living in the real world. And when you're talking about transactions settling on chain, but then the actual asset itself from an ownership perspective is sitting off chain, you're talking about now like creating this bridge, pun intended, between on chain and off chain assets. So I think from a ownership, from a custodial perspective, from a centralization of ownership of the real world asset towards this decentralized, on-chain, I don't think we've necessarily figured out that interoperability. And then the second thread, to come off of that is really from an engineering, and I'd love to hear, Lewis's take on this as well, is when you start talking about different engineering teams and different tech teams, I see Web3 native focused teams, and I see, TradFi focused engineering teams. And I think they need to work together a little bit better because it's one problem to solve. It's not two separate worlds that you're just creating an API to connect back and forth. It is, a new financial construct between having on and off-chain assets and the bridging of those two different worlds. And I'd love to see engineers focus on that together, and that includes on the security side as well. I keep hearing Web3 security and I keep hearing Web2 security. It's just security. We're securing communication, we're securing assets, we're securing access. I don't care if it's on-chain, if it's off-chain, security is security. So I think we need to start looking at it more from a security and not from a Web2, sorry Halborn, not from a Web2 security and not from a Web3 security, but we're just talking about overall security.
Got it. And is kind of core of it about custody? Is it like really custody? Is it more than custody when you think of security?
Well, I think, from a, books and records and from a reconciliation perspective, if I have a token that's sitting on chain, but at the end of the day, it's an equity that's sitting in, street name of a broker dealer, who is the actual owner of that asset? Is it the token holder? Is it the, is DTC going to say, I could, frankly, pardon, my language, I don't give a shit who the token holder is. I'm going to give it to the broker dealer and let them figure it out. I don't think we've really figured that out. And, how does that relate to security is, the security of the underlying token to the linking, to the reconciliation, to the books and the centralization. I don't think we've really fully thought through that chain end to end. And then when getting back to that, point I made earlier on, the two worlds meshing together, when I see, tokenization platforms and Web3 native, organizations and fintechs, I see somewhat of a lack of just basic understanding of financial market infrastructure and how everything works. They're building what they think the financial markets work, as opposed to bringing in, TradFi engineers and TradFi security people and saying, tell me how it works in TradFi and let me try to mirror that in the digital world, if you will. So again, I think it's that meshing of knowledge sets.
Got it. Thank you. And kind of moving on, Louis, with your kind of vantage point, both investing, building, what is your perspective on the infrastructure? We see layer ones, we see layer twos, question around interoperability, fragmentation. How does it all come together?
Yeah, it's pretty chaotic. It's a big mess, and it's very hard to navigate. And I think, yeah, a lot of institutions are struggling. They don't have the in-house expertise, security teams, engineering teams to navigate this. Good for Holborn and others like them. But I really think that's going to be a huge bottleneck in getting adoption and gaining traction quickly. I think in terms of, you mentioned about L2s and other technologies to help with scale, I think it's interesting because there, to kind of Dave's point, folks were focused on kind of one key problem, which was the scalability, the throughput. And they kind of forgot about the fragmentation, interoperability piece. So they actually made the whole space and problem set much larger. So we went from having a number of L1s all competing, then we built L2s on those L1s, and now they're competing, and then you built further abstraction on top, L3s and beyond, that is just kind of compounding the problem over time. So when you kind of look at where tokenized assets are sitting right now, they're all over the place. I mean, if you look at the top 3 L2s, there's kind of 17 billion, 14 billion, and 7 billion. Across kind of Arbitrum, Base, and OP. And then there's a long tail of kind of like 10 to 15 more, probably another 10, 20 billion across those. There's no one interface for institutions, for retail, and anyone else to access across those seamlessly. So that's a huge problem, and that introduces a massive attack surface from a security perspective. And we've seen time and time again, and even 2024, 2.5 billion lost from hacks. Over 50% of that was private key compromise, many of those related to bridges or multi-sig ownership of contracts. I think there's still a ton of problems here for institutions really to adopt this. And so I think, yeah, to Jasmine's earlier point, it's best that we start small and steady and simple and start to kind of take some of these quote-unquote reward assets and do that in a very simple way to get people familiar with like, okay, now how does this change my operational model? How does this change my technology stack? How do we work more seamlessly together? And unfortunately, a lot of the Web 2 paradigms don't map one-to-one. So yeah, I 100% advocate for Dave's requirement of bringing the two teams and two worlds together. Because yeah, in the teams that I'm building, we try and hire pretty evenly across both for that reason. And there's really quite a lot of funny situations where you're talking about some of these pain points and problems, and there's a real kind of blind spot on both sides on what the problems actually are in the first place, and then kind of get to the solutions, and the solutions that they're applying are reference points to existing solutions that they may have used over the last 10 years that don't quite fit in this new model and world. So I think in summary, there's a lot of challenges ahead. Very excited for the shifting regime and opportunities, but I do think, yeah, security and engineering are the core of this, and we ultimately need to invest more in the space and work with folks like Holborn and others in partnership to drive this forward.
And what about interoperability? Kind of now, I mean, in the crypto world, people are investing in liquid tokens across the board. They've figured out a way to get access. They've figured out a way to pay gas fees on different chains. They've way to figure out custody. Could that not just apply on the financial token side? Kind of, does it have to be drastically different? Could the same infrastructure which is built for investing and connecting to multiple chains, understanding that it's highly unlikely that one chain will rule all, you will need multiple ones. They're likely to be L2s for different purposes because people are going to be purpose-specific L2s. How do you think of this, and could we leverage what has been built for crypto and kind of repurpose it for real-world assets?
Yeah, it's a good question and thought exercise. I think the challenge still remains that we don't know who the winners are yet. And so there's still a lot of fragmentation. There's a lot of bets being made across the space from different investor cohorts and folks like ourselves leaning into certain partnerships. We can't lean into all of them. We're limited in resources, like most counterparties. And so we haven't really seen the convergence on certain domains, certain verticals, certain products being issued and managed on a particular chain or a particular layer of the stack. So I think that's still to come. And until that comes, you have to invest a lot in-house, because a lot of these tools and platforms just don't exist yet. Like, there aren't unified holistic platforms to manage custody of assets across 10 different custodians, right? You have to build that technology. Same with the L2s. There's not one seamless way to map between different L2s seamlessly and quickly. There's a lot of projects and crypto-native protocols that are trying to solve that problem. You've got like Layer 0, Chainlink CCIP, Polygon. There's many, many solutions. But again, they have covered a subset for now and are continuing to try and lean into institutional partners. So I think, yeah, for a number of institutions that are in this room and us on stage, it's super important that we are doing our bit to, one, help define the standards, two, lean in to partner as design partners with these kind of early protocols, and three, invest real capital into the space.
James, you wanted to add?
Yeah, just to add on top of that, Lewis, I think interoperability as a topic is like a whole day's conversation, right? But the principle of this, network of networks. So the dream of blockchain was always you'd have different networks specializing in different things, and they would be able to talk to each other, right? That hasn't happened yet, but that I think is where the industry needs to get to. I think we haven't made it easier for ourselves in some cases because like these L2s and then there's all these different variations, and people are using often what is a general purpose blockchain to try and do very complicated things, right? There are horses for courses, as we say in Britain. And, some ledgers like the one that we use, XRP Ledger, has a lot of inbuilt functionality for things like issuing currencies and so forth that is inherently designed into it, so it's faster and less resource intensive and everything. But no one is going to solve all of these different problems. But I think the industry is going through this over complexity cycle, and then at some point there's going to be some emerging patterns and winners, if you like, that then things will get simplified again. But that we have to get there, right? Because otherwise the frictions will actually increase rather than decrease, right? And the goal here is to try and reduce frictions.
Absolutely. Carrying the theme forward, and if you Jasmine, maybe call on you, when you think of folks in this room or institutions, and if they need to build the right risk framework. I look back at my early days of digital assets. The chief risk officer of Citi would always call me and ask for updates on everything. And even before, people might talk about regulators. My biggest hurdle was getting the risk approvals in place. Because after that, everything is okay because the diligence of the risk team would be that strong that I'll feel comfortable going to regulators. So what's the right risk framework? How should people think about building a risk framework which allows them to participate? And I think it's also important because there are opportunities here. There are opportunities to invest, access available of different kinds. So what's the right way to build the risk framework?
I think hiring the right people. It's a little naive to think that you can just sort of build a lot of this knowledge in-house without having that tangibility with somebody who's got wallet infrastructure, hands-on knowledge. Gone are the days in my life anyway where I could just run risk reports and had VAR and go done. This is an area where it's much more about the qualitative risks and the operational risks. And the unfortunate thing about that is you almost have to know the entire back to front of the work life cycle, who it is that is touching every part of that with all of your vendors, and understanding their technology. Are they using Fireblocks wallets? Are they using MPC? Or are they using sort of DFNS wallets, great wallets that are on the board there? What is it that they're doing? And the reason I say that is the number of people I've seen run smart contracts in dumb wallets is insane. It's it's like having mittens to try and use your phone. You can't press any of the buttons. So you need a smart wallet to really power the innovative capabilities of your smart contracts. So yeah, absolutely relying on your, your digitally native vendor stack, because they're going to have the expertise to be able to help you through that, and they will, because they're wanting clients and garnering that way. I would sort of advocate to not focus too much on the regulatory side and get more interested in the practicality. And what we've unfortunately seen is, an actual print of a data point which says banks are really not going to get themselves into the wallet infrastructure space by putting their hands up. And we saw that with how much interest there was to hold Bitcoin when it became an ETF. So it was like, I don't want to touch a wallet, but I want interest in this, and so I'm just going to press the interbroker button. And so the real advocation here is get off zero, understand, build yourself some wallet as a service infrastructure, start trading stuff that doesn't even matter, like widgets, and then start to work out how you build that into your workflow. But I would say that you've got to get your compliance, your operational risk, your credit risk, your market risk teams, you've got to get everybody together with your cyber team, and then build something small and go from there.
I totally agree. And I think just one thing to add there is that operations is no longer purely operational. It has to be systematic. And I think the big change here in mindset and shifting is like how technology is an enabler for operations, and how gone are the days that you can just rely on hiring tens, hundreds of operational members of staff to run around spinning plates. It just doesn't work in this model, and that introduces too many compounding risks.
And just kind of, I know we are short on time, but Dave, from your perspective, kind of when you looked at institutions and your current role, how would you look at the risk framework?
Yeah, I mean, from a risk framework, just to sum it up, going back to Risk Management 101, it's a paradigm shift in thinking through standard controls, right? We all have detective controls, preventative controls. I think transferring risk is somewhat irrelevant in this space because, who's going to lift, holding the bag when there's a, $1 billion hack? So I think it's really going back to basics and developing much more preventative controls, heightened detective controls, and to Lewis's point about, operational, incident response, and just operationalize everything and going through those tabletop exercises. There are going to be issues, there are going to be breaches. This is still a nascent and new field. There's still, startup fintechs that are solving real world problems. So it's understanding all of that from a risk perspective and then building the proper runbooks, playbooks, and just, from a risk appetite perspective, just being comfortable with it.
Got it. I know we're short on time. One last quick round question.
It's worth it. We're very negative here. There's so many benefits. The promises are insane. We could be here for days doing that. But this is the way to do it practically.
Like which asset class do you see, say, end of 2025, 2026, where you will see growth? When you look at real-world assets, financial assets?
I think we'll see more of the money market funds and treasuries. We haven't really talked much outside of the US, but there's increasing activity around the world, slightly different flavors. But I think some of these other asset classes will follow on fairly quickly. But there's going to be it's a journey, right? The end point, as you said, is going to be amazing, but it's going to take a few steps to get there.
I think mortgages, only because there's been very little innovation there. Stocks have got so much technology, they work really well. And I think people who think privates are going to come onto market, if they've written and read a 400-page prospectus, buying a token after that's not really saving you much time. So privates, I don't see being, high-octane assets, definitely.
Yeah, I'm going to go with the boring answer of stablecoins, but more from a Forex perspective. I think that's the use case.
I think market inefficiencies, so providing more structure around that. So the likes of Athena, taking a hedge fund strategy, the basis trade, putting it on chain, tokenizing it. They've got a really impressive roadmap. If you haven't looked at them, and I think we need that to stabilize and really mature the space. Perfect.
I totally believe in the opportunity. That's why assessing risk is important. But I think there's tremendous amount of opportunity, and I do see coming year we'll see a spate of innovative kind of asset issuances, investors getting it. So hopefully by the conference, this conference next year, we'll see if the market shifted. Thank you. Thank you, everybody.
Thank you.